Good evening, friends. Good evening, friends, and thank you very much for joining the webinar, wherein we'll be understanding the sector analysis from Edelweiss team, from Mr. Sahil Shah, who's the fund manager, uh, with a rich experience managing the equities for 12 years at Edelweiss Management. He is an expert in handling the Edelweiss Midcap Fund, wherein it has been a, performer, always been remain in the uh, top five mutual fund for the choice. Uh, he'll be uh, he'll be explaining us what are the outlook in this uncertain time and what we should do or what we should look at, which sectors uh, and how the Edelweiss you can uh, understand how Edelweiss fund works and you can invest into through. Uh, Over to you, Mr. Sahil Shah.
Yeah, thank you, Abhay, and thank you, IFL team. Thank you all for attending this webinar, and good evening to all of you. I will divide this discussion into 3 or 4 parts. First, I'll talk about the market outlook and what we think about the small and mid cap space. The second thing that we will talk about is the sectors that we are overweight on or the themes that we like within the small and mid cap space. And the third thing that we'll talk about is our investment process, which is very, very core to our decision making and our investment framework, which is the most important thing for stock selection in the small and mid cap space. And finally, we'll talk a little bit about the past performance about the Edelweiss mid cap fund. So first, talking about the market outlook. In terms of the outlook, I believe, and all of us would have seen what had happened to the global markets, and then what happened to the Indian markets today. This was on the back of some hawkish commentary that came from the Fed chairman. I believe that the volatile times that we have seen, which I think started with the Russia-Ukraine war, and then it followed by the inflation scare or the inflation which has been going up, which leads to more hawkish stance by the central bankers across the globe. So that volatile period is yet to get over. We are continuously seeing one after other some negative news flow, which is kind of keeping either markets range bound or leading to the fall in the overall equity markets. But there are 2 things, 2 or 3 things, which I believe are in the favor of investors who wants to invest and participate in the equity markets now for a period of next 2 to 3 years. And those are, one is the valuations. So when I look at the India's overall the large cap index valuation, it is trading at around 18 to 19 times on a 1-year forward basis, which I believe is, or which, going by its own history, it is at an average of last 10 years. So the valuations are not that demanding, I would say. Just to give you some context, the valuations at its peak in 2007 as well as in 2017, they used to be at around somewhere between 24 to 27 times. Right now, we are somewhere around 18, 19 times. Though we are not at the bottom, but at least the valuations are not demanding. Coming to the small and mid caps, again, small and mid caps during the most euphoric times, when everybody wants to participate into small and mid cap stocks, something what happened in 2007 as well as in 2017, and a bit of that we have seen post-COVID as well. The valuations typically tend to be 25 to 30% higher as compared to the Nifty 50 valuations. As of today, as we stand today, those valuations are not that demanding. They are somewhere around the valuations of the large cap index, which tells us that the frenzy around or the euphoria around small and mid caps is not that high, which is a good thing for a long-term investor to participate at the current levels. Given this, valuations are, I would say, in the favor of investors. The other good part is the earnings growth, and I truly believe that share prices are a function of earnings growth over a longer period of time and the quality of earnings growth. Earnings growth, which used to lag for a good while between 2015 to almost 2019-20, it has finally started to grow. Nifty 50 earnings in the last quarter grew by almost around 22 to 23% on a YOY basis. So that's a good growth that has come in the earnings. In FY22 as well, the growth was similar. In the coming times over next 2 years, if I have to go by the consensus EPS estimates for Nifty 50, it is likely to grow at around 15 to 17%, which makes me believe that with such kind of earnings growth that we are going to see in Nifty 50, typically small and mid cap companies tend to outperform the Nifty 50 growth, typically by around 300 to 500 basis points, which makes me believe that even if there is earnings growth that is going to come in over next 2 to 3 years in these companies at an overall level, there are good returns to be made in small and mid caps from here on. Now, at a structural level, why does small and mid cap do better as compared to the large caps? So basically, when a business is, I would say, I would attribute that to one of the biggest factor is the base effect or the size of the companies that these companies are at. These companies typically are in the very initial phases of growth and in terms of evolution as well. Having said that, these are not companies which have kind of been have emerged over last 2 or 3 years. They have been in existence for at least last 5 years, 10 years, in some cases more than 2-3 decades. But the growth opportunities are kind of coming to them now, which allows them to grow at a much faster rate, which the large cap companies, because of the size that they are at, they can't do that kind of growth. So that's what we like about the small and mid cap space in general. Now coming back to the earnings growth, there are a lot of questions which you would have read in newspapers or on TV channels about the demand outlook in the global markets. While it is true that there is a lot of slowdown, people are talking about inflation globally, but in India, what is good to see is that when the steel prices, crude prices were at its peak, we have not seen demand destruction happening at those prices. What this makes me believe is that the price increase that has happened because of inflation has been well absorbed into our markets. I mean, now let's look at some of the consumer items, like, for example, cars. We are seeing very good demand for the car sales, whether it is Mahindra and Mahindra or Maruti. They are all talking about very good bookings numbers that they are at as of now. This makes us believe that that consumers are ready to spend even when the prices of cars are going up because of the raw material prices which are going up. Similarly, the housing demand, which I believe that in at least in the Mumbai markets, that at a point of time, it was more led by some stamp duty cuts that happened. But even on that high base, the Mumbai market housing growth has continued to happen. This makes me believe that there is a lot of demand that is coming from the consumer side. I mean, look at the AC sales that are happening or that have happened in Q4 and Q1. They have seen a phenomenal growth in terms of the number of units sold in India. So the point here is that when you look at travel bookings, when you look at car booking, house booking, AC booking, I mean, take different ticket sizes. where consumer spends, and you will see that even in an inflationary environment which we have been going through, the demand has not yet tapered down. Though there are some signs in June that some managements have talked about that there is some signs of tapering, but we do believe that with the festive season coming in, this should also kind of revive. So earnings growth and demand would be the key drivers, in my opinion, which would drive the overall growth. Now coming to the sectors or the themes that we like within the small and mid cap space, one of them is the capital goods theme, where we believe that we are on an upcycle as far as the capex cycle is concerned. And why do we say so is that in 2019, also there was a lot of talk about that the capex cycle will improve, but it didn't happen that way. Now, when we look at the order book of ABB or Siemens or Thermax, which are kind of companies which where we would get lead indication in terms of whether the capex is happening or ordering of new equipments is happening or not. We are seeing very robust growth in the order book of these companies, and this is what we have been seeing over last 2 quarters. So their order books are almost at a 4-year, 5-year, 6-year high, which makes us believe that finally the capex cycle or the private capex cycle, which I think was lagging in India for a very long time, has finally kicked in. And you will also see that we have a very overweight position both in our small cap as well as in our mid cap funds as far as the capital goods sectors are concerned. Now, how are we kind of positioned within the capital goods space is also an interesting thing for you guys to understand. There are two or three ways to basically kind of play capital goods in India. One is that we buy a company which has got an overall exposure to most of the capexes that are happening in India, whether it is on cement side or on the chemical side or on the pharma side or on the steel side. We have such names in our portfolio. Few of the MNC companies that we own in our portfolio can participate in the broad-based capex that is likely to happen, and where we are already seeing first signs of improvement that is happening. But then there are what is more important in the small and mid cap space is that we get specific themes to play. Let me give you some examples. So, for example, ethanol is one of the theme that has played out in India, and it is continuing to play out in India. So there is a company which caters to the ethanol space, which is part of our portfolio. Very recently, Prime Minister Modi mentioned that because of the ethanol blending that has increased from almost 1.5-2% in 2015 to around 10% now, which is almost a 5 to 6x increase in the ethanol blending that has happened in the country. Almost 50,000 crores of forex has been saved, because the more ethanol you blend, the lesser crude that you have to import. A company which is part of our portfolio helps the sugar mills or whosoever wants to build an ethanol plant to basically kind of do an EPC work or get equipment of the and build plant on the ethanol side. That company has a very high market share in the ethanol space. So these are the specific themes that we can play in small and mid caps, apart from the diversified themes that we can play within the capex cycle. The other such theme is on the glass lining equipment side, which is basically nothing but the equipment which goes into API manufacturing or on the pharma and chemical side. Now, as we know that because of China Plus One, chemical companies are doing extremely well. They have increased their capex manifold in last 5 years, and they continue to kind of do a lot of capex in this year as well as in the coming years. So to capture that opportunity, we have a very specific play in our portfolio which can kind of capture that opportunity in terms of playing capex cycle, especially on the chemical and the pharma side. So this was on capital goods space. Then we are quite optimistic on the consumer discretionary space from a long-term perspective. And a lot of categories in consumer discretionary space, whether it is automobiles, whether it is air conditioners, washing machines, they are highly underpenetrated in India. So there is a long runway of growth in this particular companies and sub-segments of the consumer discretionary space. Plus, a lot of things are getting formalized from unorganized to organized. So we are also having companies which are kind of market leaders in the QSR space, the quick service restaurant space, the likes of McDonald's, Domino's, Subways, right? So those kind of companies have a very, very bright future ahead of them over next 5 to 10 years. And we have some of these companies which have been selected after a lot of deliberation, which are part of the portfolio now. So we believe that the other theme that can do well is the financial services theme. Financial service as a category has been an underperformer over last, I would say, 2 to 3 years, and the valuations are almost below the long-term average or at long-term average, where we believe that a lot of money can be made, especially in a cycle where things are turning around post-COVID. CapEx is going to happen where these financials will lend to companies. So we are going in the cycle, and the starting valuations are quite attractive in our opinion. So these are the few of the sectors or themes that we have in our portfolio. In autos, for example, as I was mentioning, on the consumer discretionary side, we have a lot of auto component companies invested in our portfolios. Here we are very, very choosy about the fact that we should not be getting into companies where there is electric vehicle risk. In fact, few of the companies in our portfolio will benefit because of electrification of vehicles. Now, obviously, no one knows that at what pace and when will electrification happen. But whenever it happens, at least the company should not lose out, but at best benefit out of electrification that is expected to happen in India. Now, coming to the third section, which is our process, and why to emphasize process, especially on the small and mid-cap side, is that we get a lot of opportunities on the small and mid-cap size. There are almost 400 to 500 companies in the small and mid-cap space from which we can select and construct a portfolio of 60, 70 names. But which companies to select and how to filter out kind of bad companies is the most important thing, because the under-penetration opportunity or unorganized to organized, those kind of opportunities, or China plus one, these themes are available in the small and mid-cap space. But there are also companies which have got very, very bad track record in terms of treating the minority shareholders. So the framework that we have in place is what we call as the FAIR framework. What FAIR is an acronym for 4 things that we kind of look at a very, very broader level. One is forensics, A for acceptable price, I for ESG informed, and R for robustness of the business. I'll just give you a quick glimpse around what do we mean by this. Forensics is nothing but we do a lot of accounting quality checks around the financials of the company, where we emphasize more on not only on reported earnings of the company, but also on the kind of cash flows that this company generates. And cash flows are very difficult to manipulate, but reported earnings can be manipulated. So when we look at the conversion of reported earnings to cash flows, is when we kind of understand whether the business is actually throwing cash or not, because it is the cash flows which will be utilized for further future capex, for growth, or for rewarding shareholders with dividend or buybacks, right? And that is what we want. Either we want growth or we want dividend, or a combination of both. So cash flows are the most important thing. Apart from that, we look at a lot of things like the changes in working capital, or the certain things like what we are seeing in the reported numbers, are we kind of does it match with our channel checks that we do on ground, just to understand that the reported numbers are correct or not. So those are the kind of things that we do in the forensics. A stands for acceptable price, which is nothing but we don't overpay for a company. We don't buy a company just because it is a great business and we will pay any valuation for that, because ultimately a great business also has to make money for us. That is what we are here for. And hence acceptable price kind of puts a discipline in our investment process, that we don't overpay for a great business. I is ESG informed. We believe that most of the companies in India are not ESG compliant, but over a period of time, because ESG is kind of gathering momentum globally, someday into the future, ESG will also become more prominent in India. A lot of companies have started to work in the direction of ESG. So here we are not hell-bent on the fact that we want only ESG compliant companies, but at least we have to be ESG informed and to be ready for the future of what these companies or what the investing community will be going towards. R stands for the robustness of business, where we look for companies which have got a large addressable market, which has got a fantastic execution track record, and finally everything should translate into return on capital and the cash flows. So these are the 4 factors that we look for and filter out companies. The other thing is, what I talked about was what we do, but now this is what we don't do. So we don't take outside sectoral bets, which means that typically compared to the index or compared to our peer set, we will not take outside sectoral bets. That is, what it means is that if we today, for example, from a medium to a long-term perspective, if we don't like tech as a sector or IT as a sector, we will have some stocks in IT space as well. We will not completely go out of IT stocks. That is what I mean, that we do not take outside sectoral bets. We don't take macro calls. So we don't say that US will be under recession or Europe will be under recession. So we'll be taking any macro calls on that. And subsequently, because of that, we will not take any cash calls, because we believe that once you have given us money to invest, it is for equities, and the cash calls will be taken by the clients or by the relationship manager at their level. The other key aspect of our funds is that we are true to label. That is, when it comes to small and mid caps, we don't invest in the large caps in that particular fund, because clients have come to us to give us money to invest in small and mid caps. So we don't invest in large caps. And the second is the liquidity aspect, which is another aspect apart from forensics and corporate governance in the small and mid cap space, which is more critical, where we typically do not invest in companies with low liquidity. What it helps us to do is that whenever we want to kind of exit a particular stock, our exit becomes smoother, and so does our entry into that particular stock happens with minimal impact cost. So these are the 2 key aspects of how we manage the fund or how we manage the portfolio. Now, just coming to the returns. The returns for the Edelweiss mid-cap fund, when we look at last 5 years or since inception or even 3 years, we in all this time frame, we have done much better than the benchmark. More importantly, we have been quite consistent in our performance compared to our peers as well. That is our competitors, and we have kind of been in the Q1 or Q2 in the top quartiles compared to our competitors. This data shows the XIRR made if a client would have done a 3-year SIP or a 5-year SIP or a 10-year SIP, and these are great returns to have, much better than at least the large cap index that we normally track. And this shows the consistency of returns, where almost 8 times out of 11 we have kind of outperformed the benchmark, which is our Nifty Midcap 150. Similar performance you will see for the Edelweiss small cap fund as well, where we have been quite consistent in our performance and has been in the top quartile compared to our competitors. So with that, I come to the end of what I wanted to present. Abhay, we can now have question and answers.
Thank you very much, Sahil. That was a quick understanding of the sector that you track on. And yes, ladies and gentlemen, we open the session for Q&A. Please put your questions on Q&A box. Till that time, Sahil, I have already some lined up questions for you. General questions everybody asks, to understand the to have how much we should have allocation to the mid caps and all overall portfolio. If you can just throw some light on that.
So I think it frankly depends on the from client to client. But what I would like to say is that mid and small caps definitely generate higher returns, but that also comes with a higher volatility. So clients who can kind of digest the interim volatility and especially the downside volatility which might come about in the small and mid cap funds, depending on how much you can digest, that is the kind of allocation that you can do, which can range from maybe as low as 25 to 30% to as high as maybe 60-65%. But frankly, it depends on the kind of medium-term volatility that you can digest, because over long term, mid caps have significantly outperformed the large cap index. And more importantly, what we always kind of see is the index to index performance. But what we should also see is the fund to fund performance. So very hardly any large cap fund would be able to beat the large cap index, but there are many funds, including ours, which have kind of outperformed the mid cap index, right? So when you look at the difference between the fund performance, it is even more stark in terms of the performance or the outperformance that happens when you invest in a mid cap fund or a small cap fund compared to a large cap fund. So depends on obviously the client's risk appetite, but I would so it's a very broad range that I have given you.
Thank you very much on that. Sahil, after the fantastic run from the 2020 till to 2022, now the people's greed has also increased, and you have performed fantastic in last 2 years. A general question comes in: what one should expect probably in next year? Generally, the mid caps and small caps are capped for say 3 years plus kind of stuff. So what one can expect a return and CAGR return kind of?
I mean, very hard to put a number, but as I said in my opening remarks as well, that the valuations as of today are not exorbitantly high, something that we saw in 2007 and 17. So we are somewhere in the mid cycle. We are not, I would say, at the top end of the cycle, right? Having said that, can small and mid caps correct by 10-15% in next 1 month? The answer is yes, it can correct anytime, and one should kind of build that in before anyone wants to invest in small and mid caps. But over a 3-year horizon, I would assume reasonably that the earnings growth of the underlying portfolio companies should reflect in the share price performance over next 3 to 4 years.
Oh, that was great. There's one question from Mr. Neeraj Singh Kushwa. I think he's talking about chart. I think the comparative analysis, what the benchmark and all. If you can just show it on the screen, if you can. So you would like to see, yeah, I think that the previous one. Chart flow.
This one?
Yeah, fund performance, which is the benchmark, I guess. So the chart, Sahil sir. The graphic presentation, if at all, it's.
So we don't.
It is there. No, it was there just before slide. 1 second. prior to that?
This is 3-year rolling returns, but I mean, we can send it to you separately, but we don't have a graphic representation. This is the slides on how the fund has performed, but we don't have a graphic representation of how the fund has performed compared to the benchmark. This is the data, but that you can refer to.
Okay, no problem. There's one more question from Neha Agarwal. How to identify sector which is performing while investing in equity? I would like to answer this in a candid manner, that invest into Edelweiss mid-cap fund. But if you can just elaborate a bit.
So frankly, the investment framework kind of differs between sector to sector. I mean, I cannot look with one particular lens across all the sectors, because all the sectors are different in that way.
Yes.
However, our approach towards investing is more bottom up, and a few of the parameters that we look for in a company which kind of makes a cut to enter our universe is that the company should be generating more than return on capital, which is more than the cost of capital. Cash flows, reported earnings should be converted into cash flows. So cash flows are the most important thing. Third is the execution that has been done historically by that particular company, which is reflected in the kind of market share gains that they would have achieved in last 3-year, 4-year, 5-year horizon, or the kind of market share they already have in that particular segment. And finally, we have to understand that how that segment is growing, whether it is growing in line with the GDP or more than the GDP of the country. We would typically be invested to invest in companies where the segment growth itself is more than the overall nominal GDP growth. And within that, the company has to kind of outperform the overall segment growth as well. That is something that would translate into earnings, which would finally translate into a share price performance. So that is how I would simply put it, a very generic way of looking at companies, but from sector to sector, it will be very, very different.
Thank you. Thank you very much. There's one question again from my side is how often do you churn, say, Sahil, like this company, or probably what would be the you will say, okay, I would take a call on this company. How do that process work?
Sure. So, for example, so this brings me to, so basically you are asking me that when do we exit the company, or when do we kind of change the allocation to a particular company? So there are a couple of reasons where we would exit or kind of make changes in our portfolio. One is that the investment thesis that we thought about when we started investing has completely gone for a toss for some or the other reason. Maybe promoter has the investment environment around that particular business has completely changed, or there are some new competitors which unexpectedly have entered into that market, which has made the unit economics of that particular segment or the profitability of that segment, which would come under pressure, right? So in those circumstances where our investment thesis breaks, that is when we would exit or trim down substantially as far as our positions are concerned. The second would be that we would see that there is less upside in a particular stock that is there in the portfolio, but we find more upside within the similar segment or maybe some other sector where we are seeing more upside into those particular stocks. So it's also based on the risk-adjusted relative upside that we see for the stocks which are outside our portfolio, but part of our investment universe, were compared to the stocks which are there within our portfolio. So when we see a significant difference, we would typically switch between those stocks in the portfolio.
Thank you very much for that clarity. One question from capital goods sector is that in this interest rate rising scenario, Sahil, and most of the capital goods sector is loaded by the debt side. Correct me if I'm wrong, right? So how do you select and what would be their outlook? They'll be under pressure, I'm sure, on the interest rate.
So,
in the
at
rising interest rate scenario.
Yes. So I mean, there are two parts to capex. To how do we play capex cycle? One is the infra side of it, where typically companies go asset heavy, and once you go asset heavy, you have to fund or kind of invest a lot of money, which typically would require a lot of debt. There is other side of capital, other side of playing the capex cycle, which is through capital goods space, where companies either do EPC work or they supply equipments to the private sector or to the government sector. Typically, this set of companies are either debt free or they have a very, very strong balance sheet. Given that they are not asset heavy, it doesn't require them a lot of capital to kind of grow their businesses. They do require working capital, but they don't require a lot of gross block investments into the fixed assets for these companies. So when I talk about capital goods, these companies typically have a very, very strong balance sheet. Also, what you said is true, and it used to be true at least till 2015 or 16, when a lot of companies were under debt. But over a period of time, because the investments did not happen, and because the cash flows continued to generate in these companies, or there was restructuring, the debt levels of the overall BSE 500 universe has come down substantially over last 7-8 years. What this does is that a lot of companies now are having very, very strong balance sheet. Banks are ready to fund them, and now demand has started to pick up. And that is the reason why we are seeing that capex cycle is kind of coming back.
Thank you. Thank you very much. Ladies and gentlemen, if any other further questions, please put it into Q&A. I think, Sahil, that was being explained absolutely fine. The sector analysis to understand the fund, how it works, and undoubtedly the outperformance by your fund puts tempting stuff wherein we should put in the investments. I'm sure the people who are on the call will definitely do that. Thank you very much, Sahil, for this opportunity to listen to you.
No, thank you. Thank you so much. Thanks, Abhay, and thank you, the whole team. Thank you so much.
Thank you, Sahil. That's it.
Thank you
from my side. Thank you.
Bye.